Okay, so I want to start off by just talking a little bit about EDCAP, about our organization, the Education Debt Consumer Assistance Program. EDCAP is a program initiative of the Community Service Society, or CSS. It was created in 2019 specifically to deal with the issue of student debt, which is a huge crisis in the country and in New York State. It is the second largest consumer debt next to mortgages in the United States, about a $1.7 trillion issue. Here in New York State, there are about 2.5 million borrowers that have about $98 billion worth of debt. In 2019, we established this program. It is a state-funded program which allows us to offer free educational webinars like this and also free one-on-one counseling. So if anybody, when you're done listening to this workshop, if you feel that you need additional help because you have your own specific situation, you can reach out to us and the contact information will be available at the end of this deck. And we will also, by the way, be sending this deck and a copy of the recording out to everybody um, after the after the uh, after the webinar. So we can do a whole range of things. We can basically help you with anything that you need when it comes to student loans, going all the way from filling out your FAFSA application to analyzing awards letters, all the way up to managing your loans, trying to find the best repayment options, helping you with forgiveness options, and even acting as your advocate if you're experiencing some kind of a dispute with a lender or a servicer. So, like I said, we're going to start with paying for college and the 7 college planning tips to minimize your debt. So, the first thing that you want to think about if you're applying to college is to apply to a set of diverse colleges. And you'll kind of understand the reasons more why this is more important these days as we go on in this presentation and talk about some of the new rule changes as pertains to borrowing limits that may make it a little bit more challenging for people to pay for college going forward. But you can always apply for a large range of schools, but you want to include at least one local or in-state college where the tuition may be a little bit and the cost may be a little bit cheaper. Um, Public colleges like SUNY and CUNY in the city are generally the most affordable for New York residents, particularly if you're living near the college and don't have to avail yourself of room and board, if that is an option. So just as an example, SUNY and Stony Brook, the in-state costs are about $7,000. That's for tuition. Total cost of about 30K if you're going to be living on campus. Out of state, that's all the way up to $54,000. That's per year, by the way. For CUNY, in-state is about $6,900, total about $28,000. Very often, and that's CUNY Hunter. Some of the other community colleges or the other colleges within the CUNY system are less expensive than that. And then you've got community colleges on Long Island and private universities where you can see where the costs really skyrocket. Financial aid, of course, can reduce those costs. In addition to the FAFSA in New York State, you've got things like TAP and the Excelsior scholarship, which allows you to basically it's the scholarship of last resort. And will cover up to the cost of tuition for SUNY and CUNY if your family's income is less than $125,000. The Excelsior scholarship comes with some contingencies in terms of where you live and work after you finish your schooling, but it can basically allow you to go to a SUNY or a CUNY college tuition free. And then you've also got the NYU Promise Award, which is a free tuition for families with less than $100,000. Columbia average cost after aid is something like about $21,000. What you want to do is use something called the net price calculators to compare the actual costs, and we'll be going I think, into a little bit more detail on what that actually means. Now, one of the things that you want to be aware of at this stage of the game is that don't let the brand name of the college sort of color your opinion about whether or not this is the best school to go for. I think there's a narrative that we are all used to hearing when people sort of went through the college process many years ago, that the better the school, the more valuable the degree. And while there is some truth to that in certain areas, that is becoming less and less true going forward because of the cost associated with these big name colleges. At some point, throwing 100, 200, $300,000 at a degree, particularly if it's, we've seen with some of the private institutions, people spending well over $100,000 just on their undergraduate degree. Sometimes that becomes an issue of diminishing returns. What you get in return for all of that debt is not as much value as you would think. And what you will really wind up with is spending a lot of money on paying college and not that much more in terms of your earnings power. Um, you want to apply for federal and state aid early. And this all starts with the FAFSA, the free application for financial student aid, and this is the at the federal level. The FAFSA and state aid applications should be filled out as quickly as you can once they open. So the applications for the 2026-2027 academic year, so that would be people basically that are going into school for the first time, well, for any time, but we're going into school for the first time in the fall of 2026. Those applications actually opened up, I believe, on September 24th. Typically, they open up on October 1st, but they were a little bit early this year. And even though the FAFSA aid, for the most part, is not dependent on how quickly you enroll in the FAFSA, some of the state aid and some of the non-FAFSA aid that you may get, because schools depend on the FAFSA to give out other things like institutional aid, some of that is limited. And so the sooner you fill out the FAFSA, the sooner the schools can assess that, and then look at how they're going to allocate, in some instances, their own limited resources for institutional scholarships. So where do you apply? You want to apply at studentaid.gov. That is the federal student aid website. That's the Department of Education's website for all things associated with federal student aid, whether it be grants or student loans. In New York State, you can apply for state aid like TAP or Excelsior at the New York State HESC website. Sometimes you can do the TAP application at the end of the FAFSA application, but if you can't, don't worry about it. You can just log on to the HESC website, and you can complete the TAP application there. In terms of federal and state grant maximums, these numbers are from 2025, 2026. We don't have the numbers for the 2026-2027 academic year yet. By the way, the 2026-27 academic year starts July 1st of 2026, ends June 30th of 2027. That's how the academic years work. So as of the last year, federal Pell Grant maximum, and these are needs-based grants, were $7,395. That's maximum if you qualified for the maximum, and can be applied to both tuition and room and board. Federal Supplemental Educational Opportunity Grant, or FSEOG, that's a grant that's even more needs-based than the Pell Grants. You can get up to $4,000. Again, can be applied towards tuition or room and board. The New York State Tuition Assistance Program, TAP, maximum last year, again, last academic year, was $5,665, can only be applied to tuition. And then some students can get up to $6,000 with the enhanced tuition award if they do attend a participating private school in New York State. The Excelsior Scholarship then would cover the difference between total tuition costs only, again, this is tuition only, and other financial aid that you might have received for CUNY and SUNY schools only. Now, I mentioned a little bit earlier that there was a contingency. This program does require that if you receive an Excelsior scholarship, once you graduate, you must live and or work live and work, I should say work and or live, in the state of New York for the amount of time that you receive the Excelsior scholarship for. And if you don't do that, if you breach that, then that grant would turn into a non-interest loan. But for the most part, I think people are able to honor this. If you're not working, you just simply have to reside in the state. If you got the Excelsior scholarship for 2 years, you would just have to reside in the state for 2 years to make sure it continued to be a scholarship. If you're working, you have to make sure that you're working in the state as well. Making scholarships your job. So scholarship hunting, as aggravating as it can be, is a and should be, frankly, a full-time job. This is um, a source of potential funding that I think is probably going to become a little bit more important going forward when you understand sort of the changes to the borrowing limits. But it's essentially, remember, scholarships typically are free money. Although you should always check the terms of the scholarship to make sure that there aren't any conditions attached to it. But for the most part, this is money that you're going to get that you don't have to repay, and it's money that you don't have to turn around and borrow, which does have to be paid back. You want to craft a very strong personal statement for yourself and write a solid essay that can be applied to different types of applications. And then you want to, again, line up your references because you're going to need references for a lot of these scholarships. You want to line them up early. So you want to ask your teachers, your mentors, um, employers, anybody in the community that would sort of lend some weight to the reference. And again, apply broadly, targeting all the different schools and or, that we talked about before, local, national, niche scholarships. There are websites that have literally thousands upon thousands of scholarship options that could be based on it can be based on talent that you may have. It can be based on some disabilities that you may have. It could be based on interest. It really could be based on a wide range of things. And you can use some scholarship search engines. We've got a couple of recommendations in the resources section of the presentation. Now, knowing your borrowing limits, this is where we start to get into the nitty-gritty of the numbers. If you need to borrow, and many people do have to borrow to go to school, you only want to borrow what you truly need. And this is why we say you want to go through the exercise of finding all of the free money that you possibly can before you turn to borrowing. Um, if just because you're offered a loan and you may be eligible for the maximum amount of loans in the student loan system, if you don't need it because you're getting other sources of funding, you don't have to take it. And then what you should be thinking about is how much can you affordably pay on that debt once you figure out how much debt you're going to be taking on. And this is kind of a guide for debt at different levels. So just as an example, if you had a loan balance of, let's say, $75,000 and an interest rate of 8.94%, if you pay that back over a 10-year period, the monthly payment would be about $947. If you extended that out to 25 years, if that's an option, and by the way, that may not be, 25 years may not be an option for all of these debt levels in the federal system. But if that's an option and you wanted to extend it out, you could pay less, lower amounts on a monthly basis, but you'll be paying more over the life of the loan. So this is, sort of just standard loan 101. The longer you pay on a loan, the more interest you will pay over time. But sometimes if you can't afford the high monthly payments, you have to extend it. You think about it like you would think about a mortgage, right? A lot of people take out 30-year mortgages. They would take out 15-year mortgages if they could, but they can't afford the payments to get it paid off in 15 years. Use loan calculators. We have a loan calculator on the EDCAP website. It's a student debt payoff calculator to get a sense for how these things work, and talk with your family about what is actually realistic. You want to consider both your future income and also your parents' income if they're going to be co-signing or taking out loans, Parent Plus loans in the federal system. So this requires a fair amount of planning, but you're going to be really grateful if you think about this stuff before you just sign on the dotted line and take on ultimately an amount of debt that you figure out later on down the pike that you can't pay back. So if you do have to borrow, you want to probably start with federal loans. Federal loans in general, even with the changes that are going into effect, have some advantages that private loans do not have. So at the time that you take them out, they typically do have lower interest rates than private counterparts. Federal interest rates are fixed over the life of the loan. So, down the road, if interest rates go down, the private loans may look more attractive. But at the time you're taking them out, where the interest rates are based all on the same interest rate environment, the federal loans are typically going to have lower interest rates. There are no credit check or cosigner needs for undergraduate and graduate direct loans. And when I say graduate direct loans, we're talking about anything other than a plus loan. And then repayment doesn't have to start until after graduation or a change in enrollment. Of course, you can always pay while you're in school if you want to, but you don't have to. Whereas with private loans, it can be a little bit different depending on the lender. And then at the end, when you are done, you typically do have some more flexible repayment options to pause payments, and forgiveness programs that you might be able to pursue, which we're going to go over in the second part of this presentation. Okay, so this is a really important slide, and this is going to be sort of part and parcel of our conversation about pre-college counseling and funding higher education, paying for college, and how to manage debt going forward. This is one of the key changes that is coming out as a result of the new budget bill that was signed into law in July of this year. And most of these changes are going to go into effect in July of 2026. But it's really important at this point for anybody that's kind of embarking upon this process, or anybody that might be in the middle of it, that you understand what's changing and what's not. So when it comes to borrowing for undergraduate school, that's direct subsidized and unsubsidized loans for undergraduate school. Current interest rate on those loans is 6.39%. There is no change to that, and we're going to go over that in a little bit more detail in the next slide. The changes start with the plus loans and the loans for graduate schools. So starting with Parent Plus loans. Parent Plus loans are loans that a parent can take out for a dependent undergraduate student that will currently cover up to the cost of attendance. So it's basically you can borrow the cost of attendance less whatever other aid your child has received for their undergraduate degree. The interest rates are on these loans. Plus loans are always the highest interest rate within the federal system, currently 8.94%. By the way, these interest rates change annually based on prevailing market conditions, usually around the time of just before the academic year starts. So these are the rates that will be applied to loans taken out between July 1st, 2025 and June 30th of 2026. Starting next year, there will be a different set of rates. But no longer will you be able to just borrow up to the cost of attendance. There will now be an annual limit of $20,000 per child and a lifetime limit of $65,000 per child that you can borrow, and that's between both parents. So that, for anybody that's trying to send a kid to a private school, or even sometimes a SUNY school where you're living on campus, you know that some of these limits may not do the trick, and may cause you to either find additional sources of funding, or to reconsider the cost of the school that you're applying to, and think about maybe applying to some more affordable options. Now, there is a grandfathering clause for these Parent Plus loans. If the student receives at least one direct loan before July 1st of 2026, or if you as the parent get a Parent Plus loan, you can continue borrowing under the current rules, meaning that you can borrow up to the cost of attendance for up to 3 additional years to support the same uh, uh, degree and program that your dependent student is studying. The caveat here is that even though you can borrow for another 3 years under these circumstances up to the cost of attendance, when it comes to paying them back, you have to pay them back under the new rules, which we'll talk about a little bit later. Direct unsubsidized loans for graduate school, these interest rates are about 7.94%. These are changing as well. So for master's degrees, the annual limit is actually not changed. It's $20,500, but there's now a lifetime limit of $100,000 to get your graduate degree. That's over and above what you pay for undergraduate school. If you're pursuing a professional degree, like a law degree or a medical degree, it's a $50,000 annual limit up to a lifetime limit of $200,000. Now, you might say to yourself, well, that's still a lot of money. I mean, it is a fair amount of money, but when you think about, we see many people with law and medical degrees that have three, $400,000 worth of debt. So it may not cover everything. And what used to cover everything were the Graduate Plus loans. Graduate Plus loans, again, have the same interest rate as Parent Plus loans. The Graduate Plus loan allowed a graduate student to borrow up to the cost of attendance for their graduate program so they could effectively complete their entire program within the federal system. The Graduate Plus loans are going to be phased out starting July 1st of 2026. But there is going to be some grandfathering, again, similar to the Parent Plus loans. If you have a Graduate Plus or a direct loan that was dispersed prior to July 1st of 2026 for a graduate degree, you will be able to continue to borrow up to the cost of attendance for another 3 years to complete that course of study. Again, you'll have to pay back under the new rules. That's less onerous for the Grad Plus borrowers than it is for the parent borrowers, but we'll get into that a little bit later. In terms of the federal borrowing limits for undergraduate students, this is where they stand, and this is not going to change. If you're a dependent student, your annual limits are going to be anywhere from $5,500 to $7,500, with no more than $31,000 allowed in aggregate for your undergraduate degree. If you're an independent student or a dependent student whose parents can't get a Parent Plus loan, because there is some credit checking on the plus loans, you can borrow between $9,500 and $12,500 per year, and up to a total of $57,500. Private loans, this should be your last resort for funding. I mean, you want to kind of really just explore every other option before you resort to a private loan. These loans are going to be offered by banks, credit unions, private institutions. Credit checks are going to be required, and interest rates will and the terms of the loan will be assessed largely on the basis of your creditworthiness and the creditworthiness of your cosigner, which is typically going to be a parent or another adult who has a decent credit score that will qualify. Just remember that cosigners are 100% liable for the loan if the primary borrower, which would be the student, defaults for any reason. So if you're considering cosigning, or if you're thinking about taking on a cosigner, just remember your fortunes are tied together once there is a cosigner on the loan, and it can be very difficult to get a cosigner release, particularly if the primary borrower starts to struggle. And then we talked about interest rates being determined not just by the prevailing market conditions, but also by the creditworthiness of the applicants. You want to review all the financial aid offers carefully, and you definitely want to look beyond the first year so that you fully understand the program costs. That may be where sort of, looking at some of these calculators, if you know what you're going to have to borrow for the first year, you might sort of extrapolate that for another 2 or 3 years, depending on how long it's going to take to complete the degree, and really try to figure out how much debt you're going to wind up with at the end of it. And just remember that aid packages can change, particularly first year scholarships. A lot of these scholarships are one time only. So you want to make sure that you understand the terms of the scholarship. If the school tells you that the scholarship is good for 4 years, you want to make sure you get that in writing. You want to analyze your awards letters. This is what you get back after you submit the FAFSA, and you have an idea. It kind of lists all of your aid, the cost of attendance, and the net cost, which would be the cost of attendance less any scholarships and grants, basically any free money that you get. The rest of that is called net cost, and that can be funded with federal student loans, which have to be paid back, your own family resources, or private student loans, or private student loans, things like Parent Plus loans as well. So there are a number of awards letter analysis options online that you can find. I know HESC has one. I wouldn't be surprised if at some point EDCAP will have one. We don't have it now, but we hope to have one in the future. But you want to see kind of a side-by-side tool that allows you to compare the actual cost once you have the awards letters of your schooling. So again, that allows you to see the net cost, to know exactly how much money is going to come out of your pocket to fund school. And then negotiate your financial aid package. You can do this. You can ask for more aid. And by the way, you mainly can do this in the first year, and that's when you want to do it, if you are so inclined. Um, you can, but you can also do it if sort of life events happen that cause you to reassess your financial situation. Sometimes colleges will reconsider your financial aid package. Again, it's best to do it in the first year, and see if you can get a more generous offer than other colleges are offering. And if you do get that offer, again, if it's a scholarship, you want to make sure it's going to extend beyond that first year. Some of the questions that you might want to ask is, can my aid be reconsidered based on my current situation going forward? Is there a formal appeals process that you can follow if you're not happy with the aid that they have granted you? Or are there any other additional scholarships or grants that you can apply for? So some of the tips, just, you never want to kind of be testy with people that are trying to give you things. So you want to be polite, you want to be clear about what you're asking for, and make sure you have a well formulated document, particularly if you're sort of saying that you need more aid based on your financial situation. You want to have supporting documents to show that. And then reassess on an annual basis. So you can reevaluate your strategy every year. If you start out in one place and you decide that either you don't like the school, you just realize this is just going to cost way more money than we can afford. The sooner you make those important decisions about whether or not you should um, do something else, the better off you're going to be overall. But just remember that there are ways to offset the costs. So some of the things that you can look at are work study programs. That's actually comes through the FAFSA application. To avail yourself of this, you have to be eligible for it, and then you must seek out the jobs and work to earn the money. And then if you're living on campus, you might consider becoming an RA or a resident assistant to get free housing. Campus jobs such as like lab assistants, again, may offer things like tuition waivers. And then, of course, you can always look into summer jobs and paid internships. So that completes the section on paying for college. And give me 1 second, and I'm going to go in and say, open it up for questions. But hold on, I think I have to change one of the settings to do that. Hmm. All right, I'm going to stop sharing for a second, see if I can find this. Okay. Okay. So everybody should be able to hear me right now. I'm going to start with Emily to see if there are any questions that you want to elevate.
Not particularly. We had a couple different questions. The main thing people were asking is, are we going to get a copy of the presentation and the recording afterwards?
Yes, you will get copies of the presentation and the recordings.
And then a few people are saying, can we mute the Spanish translation? We're hearing both at once. I think that just popped up though.
Well, you might be hearing that right now because I had to change the settings so that everybody can hear in the webinar. I will go back to the setting when you were only hearing Carolina translate in a minute. So if there's no more questions, I'll do that right now. Carolina, was there any questions that you wanted to raise? Okay. Okay, let me go back and share, and we'll start the second part of the presentation. Okay, so now we're going to be talking about managing student debt. So now you've gone through the whole paying for your college process, you've paid for it, you've taken out whatever loans you needed, and now it's time to pay the piper. What do you do? So we're going to talk first initially about some of the important updates. And this is most of what we're going to be talking about here. It pertains to federal student debt, which is the vast majority of student loans. It's about 92% of the total student debt in the country. So starting with some important updates about the federal system, of course, the most recent being the government shutdown, which does impact it impacts some aspects of the federal student loan system, but not necessarily all of them. So let's talk about what's functioning and what's not functioning and what to look out for. So loan servicers, and these would be the Nelnets and the Advantages and the Mohilas. These are the folks, these are not direct government employees. These are third-party organizations that are contracted by the federal government to manage your debt. So they are the ones that send the bills that you make payments to, that process certain types of applications like IDR applications, consolidations, requests for forbearance. Those folks do have an appropriation and they're funded right now. So we haven't really seen any significant change in the servicing aspect of your loans. Now, if the shutdown goes on for a prolonged period of time, that could change. But for now, it's sort of business as usual when it comes to the servicer function. The FAFSA applications, which we were talking about a little while ago, that is open now. New loans and Pell Grants for the current semester, fall 2020-25, should have already been dispersed. Only in a rare few occasions where people are asking for loans very late in the process might there be an issue. And then, of course, the loans for 2026, 2027 won't be dispersed until next year. So you can still fill out the FAFSA application to get an idea of what your aid is going to be. Now, what will be delayed or what might be impacted is if you have any kind of problem or issue that generally would require the Department of Education to resolve. Those folks, for the most part, have been furloughed. So anywhere from 85 to 90% of the department has been furloughed, including the Office of the Ombudsman, which is going to make it difficult to resolve those disputes, virtually impossible to get a dispute that requires that ombudsman's input.
Nancy, so sorry to interrupt. I
Yeah.
think everybody's still hearing both the English and Spanish.
Carolina, can you let me see? I'm not hearing it on my end. So Carolina, I don't know. Are you able to change your setting? Let me see. Carolina, I can hear you. People are okay. It might have been that some people just didn't have their settings, their audio settings muted correctly. But okay, we'll just stop and we'll go from here. I trust everybody. I'm hoping at this point everybody can hear me.
We can hear you. Maybe not everyone has the original audio muted.
Well, anybody also that selected Spanish would have to switch to English, I think, to hear me at this point.
Gotcha.
So I don't know if Carolina, you can say that. But anyway, we'll start. We'll go ahead and just do it all in English from here. Uh, where am I? Sorry, I'm trying to find my place in the deck. Just give me 1 second. Here we go. Okay. Okay. Um, So we were talking about the sort of key updates in the One Big Beautiful Bill Act, and that's the last time I'm going to mention the word beautiful. The OBBBA, which was the new tax and spending cut bill, which went into effect in which was signed into law in July of this year. They introduced some very sweeping changes to the student loan system. New borrowing limits, which we already talked about, new repayment options, which we're going to talk about, changes to some of the income-driven repayment forgiveness, and elimination of short-term relief programs. All were included in this bill, many of which will go into effect in July of next year. The one thing that this bill did not address was the Public Service Loan Forgiveness Program, PSLF. For anybody that may be pursuing public service loan forgiveness, that is its own statute. It has that has been that has it's basically been in law for since 2007, and that law was not touched in the OBBBA. However, there is this other process called negotiated rulemaking, which is ongoing right now, which is done at the Department of Education level, where they are trying to make some changes and redefine what is considered to be a qualified employer for public service loan forgiveness. We'll be doing more informative webinars on this subject as we go forward. If this rule does get finalized, it would not go into effect until July of 2026, and we would expect to see certain responses between now and then. So nothing has changed about the PSLF program right now. If you were eligible for PSLF last month, you're eligible for PSLF this month and the month and next month, and there so on and so forth. The end of the SAVE plan, as you probably are aware, the SAVE plan was the cheapest repayment plan that would have been available to borrowers. This was offered by the Biden administration in 2023. It was a much more generous plan, probably was going to be the most affordable option for the vast majority of student loan borrowers. But it was challenged in the courts in April of last year, and starting in July, an appeals court put an injunction on the Department of Education, preventing them from basically billing anybody using the SAVE formula or enrolling new borrowers. And if you were enrolled in this plan as of July of last year, you were placed in a forbearance. And the forbearance will end whenever the court decides to rule on the challenge, which they have not done yet. Which is why you may, if you're in the SAVE forbearance, you may see that forbearance date keeps getting pushed back. The latest date that I saw was sort of end of January, early February of 2026. This could be extended. Just remember that the time spent in this forbearance does not count towards loan forgiveness. When they initially implemented this forbearance in July of 2024, it was a non-interest bearing forbearance. That changed in August 1st, in August of this year. So starting August 1st, interest is accruing if you're in the SAVE forbearance. That doesn't mean that you have to get out of the SAVE forbearance right now. It doesn't mean that you have to make a payment, but the interest will accrue on your account. And last we heard, there are still about 7.7 million borrowers enrolled in the SAVE plan. It's probably a little bit fewer than that right now. A lot of people are looking to get out of this at this point. If the plan is not struck down by the courts, and by the way, we're just not expecting a favorable decision whenever that may come, but it is going to be eliminated under the terms of the new budget bill. So it's going to go away one way or another. It may go away sooner than a couple of the other plans that are being sunsetted. We just at this point don't know. The one thing you can't do right now is really you cannot make a payment based on the SAVE formula. So now we're going to be talking about the future of student loans. For borrowing limits, I just went over those. I'm not going to go over them again. These will be the ones that would be effective July 1st of 2026. You can refer back to slide 13. But we are now going to talk about repayment plans for future borrowers. And this is really important because people who are not done borrowing are going to have more limited choices going forward. So if you're a student borrower, there's going to be a different set of rules for parent borrowers. But if you're a student borrower and you're taking loans on or after July 1st of 2026, you're only going to have two options. You're going to only be able to pay in the standard fixed repayment plan, a new version of that plan where that's where the payments are based on the size of the debt, the interest rate, and a predetermined payback period. And that payback period is going to be anywhere from 10 to 25 years based on the size of your debt. So the standard plans are like paying back a regular consumer debt. So the fixed version of the plan would be like paying back a mortgage or an auto loan. You make the monthly payment over the life of the loan, after which you've paid the entire thing off, including all the interest. And then there will, for anybody that takes a loan on or after July 1st of 2026, for if you're a student, you're only going to have one choice of a plan that's based on your income. So right now, there are four different income-driven repayment plans, IDR plans. That's an umbrella term for all the plans that are based on your income. There's the SAVE plan, even though that's tied up. There's IBR, there's PayE, there's ICR. If you take out new loans on or after July 1st of 2026, the only plan that's based on your income that you'll be able to enroll in is Repayment Assistance Plan, or REP. It's going to calculate payments at 1 to 10% of your adjusted gross income. It would reduce that payment by $50 for each dependent that you claim on your tax return. That's a less generous definition of dependence than in the current IDR plans. It's going to require a minimum payment of $10. So even if you have no income or very, very low income under the current plans, you could get a $0 plan. Going forward, you would have to pay at least $10. Now, on the plus side, there is going to be a $50 monthly principal subsidy. So if you're not able to reduce the amount of your principal by $50 each month, the government will do that for you. Spousal income can be excluded when filing separately. So that's good if you're the only one, if you're married and you're the only one with student debt. You don't want to have to base the payment on your combined income if you've got nobody to share that payment with. And that will help reduce your monthly payments. Under this plan, however, there's no protected income and no adjustment for inflation. So really what that means is under the current plans, there's a certain portion of your income that they cannot assess a payment on, which generally can lower the payments. And there is an inflation adjustment every year for the current plans. There will not be for the new RAP plan, which means if your income does not keep up with the cost of inflation, you might struggle a little more to make the payments in these plans. Again, back on the positive side, though, the unpaid interest. So if your payment doesn't cover the cost of the interest on the loan on a monthly basis, you will not have to accrue the unpaid interest to your account. Right now, for all of the other plans, if you make a payment and it doesn't cover the cost of the interest, which is often the case if you have a high debt balance and a moderate income, that unpaid interest gets added to your account every month, and that's why you tend to see your student loans balloon. Under the new plan, as long as you're making whatever the required payment is, that will not happen. So that's actually a good thing. This plan will offer forgiveness, income-driven repayment forgiveness. This is separate from PSLF. All the current IDR plans offer forgiveness if you make payments between 20 and 25 years. Under the RAP plan, you would have to pay for 30 years to get that kind of forgiveness. But the plan will also be eligible for public service loan forgiveness. Okay. So now let's talk about what this landscape is going to look like for student borrowers, and then we'll go into Parent Plus borrowers. And we're going to put people in sort of different categories here. We're going to start with existing student borrowers. You may hear me refer to them as legacy borrowers. These would be people, if all of your loans were dispersed prior to July 1st of 2026, you don't have to do any borrowing on or after July 1st of 2026. You will have more options than new borrowers will. So you're going to be able to continue to access the PayE and the ICR plans under the current rules, and a modified version of the income-based repayment, or IBR plan, when that becomes available. You're going to be able to access all those plans until July 1st of 2028. Now, PayE and ICR are going to be phased out on July 1st of 2028, as will SAVE if it still exists, if it doesn't get killed by the courts first. At that point, the only existing plan that will live on beyond July 1st of 2028 is income-based repayment. And again, that's only for borrowers who don't take out any new loans on or after July 1st of 2026. After July 1st of 2028, if you're in payee or ICR, you would be transitioned to the modified version of IBR. So let me explain what the rules of IBR currently are. So IBR has what's called an income test. If you're not enrolled in the plan and your income is very high in comparison to your loan balance, you may not be eligible for the plan. If you are enrolled in the plan, however, you would never have to pay more than the equivalent of the standard 10-year fixed repayment option. So the current rules of IBR, there is an income test and there is a payment cap. There's also two different versions of the IBR plan. If you if you have any loans that were dispersed prior to July 1st of 2014, you're only eligible for the older version of IBR, where the payments are calculated at 15% of discretionary income, and balances would be forgiven in the IDR forgiveness program after 25 years of qualifying payments. If your first loans were dispersed on or after July 1st of 2014, payments would be calculated at 10% of discretionary income. Balances will be forgiven after 20 years of qualifying payments. These borrowers now, current borrowers would have access to these IBR plans based on when their loans were dispersed. And they would also have access to the new WRAP plan if that proved to be a cheaper plan. Now, in the recent budget bill, they did modify the income-based repayment plan so that there will be no income test going forward, but the payment cap remains. The only issue is that they have not yet fixed the systems to remove the income test. So some borrowers, even though the new rules for IBR should have been effective immediately, practically speaking, some borrowers, again, if your income is very high compared to your loan balance, and you're not enrolled in IBR, you may not be able to get into the plan just yet, but they're looking to fix that hopefully by the winter. That timetable may slip a little bit because of the shutdown, but certainly within the next few months, we would expect that to be fixed. Now, if you are a new student borrower, or if you're an existing borrower, you have current loans, but you take any loans on or after July 1st of 2026, you're only going to have access to the new version of the standard fixed repayment plan or the WRAP plan. So basically, if you take loans on or after July 1st of 2026, that makes you a new borrower, even though you may have older loans. Now, when we look into what happens with Parent Plus borrowers, it becomes a little bit more uh, stark in terms of the choices. So again, existing Parent Plus borrowers, these are people who are done and have all their loans dispersed prior to July 1st of 2026. In order for you to retain access for any of the income-driven repayment plans, which for now would be ICR, you will also eventually be able to enroll in IBR. You must consolidate your loans and have a fully dispersed consolidated loan before July 1st of 2026. If you already did the consolidation on your Parent Plus loans, you're good with that aspect of the rule. If you have not, if you just look at your account and it says direct Parent Plus loans, and you're not planning on borrowing anything else beyond July 1st of 2026, and you want access to income-driven repayment plans, which give you access to forgiveness programs, you must do this consolidation, and it has to be completed before July 1st of 2026, which means that we are recommending that you actually file the application no later than April 1st of 2026 to allow time for the consolidation application to be processed. They generally take about a month to 2 months. You want to allow a little extra time. If you can consolidate it sooner, you want to consolidate it sooner. Now, recent guidance from the Department of Education says that once you consolidate your loans, you must enroll in the ICR plan, which can be an expensive plan, and make at least one payment before you transition into IBR, which for a lot of people is probably going to be cheaper than ICR. These rules are in the process of being finalized. They could change, although based on what we're hearing, it's not likely that they will. So this is something the enrolling in the ICR plan doesn't have to be done by July 1st of 2026. You just need to make sure that you're fully consolidated. If your loans are in the ICR plan, which is going to be phased out on July 1st of 2028, you would then be transitioned into IBR if they're not already enrolled. Parent Plus borrowers are not going to have access to the RAP plan. So it's going to be either IBR for beyond July 1st of 2028, and that's only for people who are done borrowing before July 1st of 2026. New Parent Plus borrowers, this includes anybody that takes a loan out on or after July 1st of 2026. This is for parents, for Parent Plus borrowers, you can only pay those loans back in the standard repayment plan, even if your loan is consolidated. So what that effectively means that you're not going to have access to any income-driven repayment plans, and there's going to really be no path for you to get IDOR or public service loan forgiveness. So if you're an existing borrower, you take any loans out on or after July 1st of 2026, they're all going to have to be paid back in the standard plan. And I know this is a lot. It's very complicated. If you're a Parent Plus borrower, we urge you to kind of reach out for a one-on-one consultation to learn more about this and make sure that you're set up to do what you need to do to keep all the options that you have available to you going forward. And if you do have to continue borrowing beyond July 1st of 2026, based on where you are in the borrowing cycle, you may want to consider alternatives to borrowing in the federal system just so you can retain your access to forgiveness for whatever loans you already have. This is just an example of what the new RAP and the IBR plans will look like. For the purposes of this example, when it comes to determining the payment cap in income-based repayment, I am assuming a loan balance of $85,500 and an interest rate of about 6.58%. That puts a cap of $974 on the IBR plan if your income is high enough. And then in terms of family size and dependents, we're assuming a family size of 2 for IBR and a number of dependents for the RAP plan as 1. You can see at the lower income levels, the RAP plan, other than the very lowest, actually compares more favorably than the different IBR plans, particularly the more expensive version of IBR. But once you hit the higher incomes, if there's a cap that comes into play on the IBR plan, the RAP plan can become a little bit more expensive. Actually, it can become a lot more expensive depending on how much you earn, and there is no cap in the RAP plan. Other changes, loans that are dispersed on or after July 1st of 2027 are going to have fewer temporary relief options, so that you will not be able to get an economic hardship or an unemployment deferment. And you can only be in forbearance for 9 months during any 24-month period. Now, I will say that if you're eligible for an economic hardship deferment, or even an unemployment deferment, you're generally going to be eligible for a very, very low, if not $0 repayment plan, as long as it's not the RAP plan. But the forbearance is a tool that a lot of people use when they really have no other options. Under the current rules, and if you have for all loans that are dispersed before July 1st of 2027, you can use the current rules, which means with a forbearance, you can get up to 3 years worth of general forbearance on per loan over the life of the loan. Other changes effective July 1st of 2027, if you have a defaulted loan, the rehabilitation process is one of the ways you can get out of a student loan default. Right now, you can only rehabilitate a loan successfully once. Starting July 1st of 2027, you will be able to rehabilitate your loans twice. And then there are certain discharge programs called Borrower Defense to Repayment, which basically is a claim that your school is guilty of some kind of fraudulent behavior and close school discharge if your school closes while you're in the program or shortly after you leave the school. Biden era rules, which would have made it a little bit easier for borrowers to successfully get their a successful claim and stop having to pay and get their loans discharged. Those have been pushed off until July 1st of 2035. And also, there's a court challenge to these to the Biden rules. These two discharge programs have historically been very difficult to successfully navigate, particularly the BDR claim and the BDR defense. If you think you're eligible for BDR based on your school's conduct, we do encourage that you submit the applications. They're very long. They're like 20 or 25 pages long, and we can help you through it. But you should be cautious about relying on that to receive actual discharge. And you want to seek out advice before you do it because there are other things that you might want to know about whether or not you should stay in forbearance while you're waiting for the claim to be resolved. These claims literally can take 3 to 5 years, if not longer, to actually get a response. So, if you think you worry about the school, you had some bad experiences, and it has to be actual fraudulent behavior on the part of the school, not that you just didn't like the program or you had a bad experience on the campus, you can reach out to us and we'll give you some advice. Okay, I'm going to stop there and see if there are any questions, whether it's Marie or Carolina or anything you want to add.
Nancy, there are no questions pertaining to this in the chat. I don't know if anyone wants to add them in right now. We can elevate them to the whole group.
Okay, well, and you can add them in, and we'll also come back to them towards the end as well. Okay, so we're now going to go on and talk a little bit about the strategies for tackling debt. Typically, when a client comes to us, they come to us because they have an immediate issue that needs to be resolved, which is always important, of course, whether it be that you can't afford the plan that you're in, if you're in default or about to go into default, and you're trying to prevent involuntary collections. These are all things, of course, that we will address when you come to see us. But one of the things that we always try to leave our clients with, and everybody should be thinking about, is what is your long-term strategy for getting rid of your debt? And we have found that through the years of us doing this and through the thousands of clients that we've seen, we have found that basically people fall into three different buckets when it comes to strategies for paying off debt. And the three buckets are, number one, pay the debt in full as quickly as possible. So this is typically what people think about when they take out debt. Oh my gosh, I'm going to have to pay this all back. Now, as you're going to see in a minute, in the federal student loan system, that isn't necessarily the case. But if you borrow federal student loans or even private loans, but within the federal system, if your income is high in comparison to your debt balance and you can afford to make extra payments on the loans or lump sum payments on the loans, this is probably going to be the strategy for you. If your goal is to just pay it off, then you want to pay as aggressively as possible. That may mean making, again, lump sums or short-term higher payments. But the sooner you pay the debt off, the less interest you will pay over the life of the loan. The second bucket is really where the majority of our clients reside, where you maybe have a loan balance that's quite high, but your income is low to moderate. What you need to do at that point is identify a forgiveness program that you are eligible for, something like public service loan forgiveness, which is a 10-year path to forgiveness, or that IDR forgiveness if you don't have the employment requirements to do the PSLF that would get it forgiven in 20 or 30 years. Identify the forgiveness program, make the minimum required payments until such time as you get your loans forgiven under the terms of that program. So the analysis really there is you take a look at your debt balance and then you figure out what forgiveness program you're eligible for. And let's just say, for instance, you're eligible for PSLF, which is a 10-year path to forgiveness. You say to yourself, is there any reasonable expectation that I could eliminate my entire debt faster than I can get forgiveness? If the answer to that question is no, then really what you want to do is just make the minimum payments until you earn the credit to get the loans forgiven. And then finally, I'm just going to ask, I know somebody's got their hand raised, but I'm going to ask that we save those questions till a little bit later, or you can type them into the Q&A. And if it's a technical issue, let me know. But the last the last bucket, okay. So the last strategy would be to pay the minimum required amount until death do you part. Now, that sounds very depressing, but we have it here for a reason. Um, the reason is that in the federal student loan system, forgiven debt that is discharged, forgiven debt is discharged in death. And what that means is that if you're the borrower on the loan and you die, the debt obligation does not pass down to your estate and therefore does not pass to your loved ones. And that's different from from how they treat forgiven or canceled debt on other consumer products, most consumer products. In most cases, that canceled debt or forgiven debt is considered income, and either the estate would have to deal with the debt obligation or the beneficiaries of the decedent would have to do that. That doesn't happen in the federal student loan system. So this strategy is typically going to be for older borrowers who maybe took out late in life loans or who have a lot of Parent Plus loans for their kids, but they're about to enter retirement and they no longer are going to have the PSLF option, and they realize that they're just going to be paying for 20 or 30 years, where if you're 50, 60, 70 years old, that could be the rest of your life. So you just find the cheapest repayment plan that you can find and make those payments until you pass, and know that this burden isn't going to pass down to your loved ones. And then, of course, part and parcel of your strategy is always going to be choosing the right repayment plans. As we discussed, those options are going to get fewer as we go forward, particularly for newer borrowers. But your choices are typically going to be the traditional repayment plans where the payments are based on the size of the debt, the interest rate, and a predetermined payback period. Again, that's going to be for people who are just looking to pay the debt off. Or you're going to look for an income-driven repayment or IDR plan. That's the umbrella term for things like IBR, pay as you earn, ICR, and then the WRAP plan, which is not available just yet. And the benefits to that, obviously, they can be more affordable. They offer forgiveness after periods of time. And so they're going to be better suited for people that have higher debt balances and low to moderate incomes. I want to say a word about income-driven repayment forgiveness and the IDR account adjustment. So income-driven repayment forgiveness, we've been talking about it. Again, that is just by virtue of being enrolled in any one of those IDR plans. If you make payments for 20 or 30 years, your loans are supposed to be forgiven after that time period. There is no employment requirement for this program. So this is going to be the default forgiveness program for borrowers who have these high loan balances, moderate incomes, but they don't have a job that qualifies them for the public service loan forgiveness program that would be a faster path towards forgiveness. Now, this is a program that has been around since the 90s, and was really, really poorly run for a long period of time. Right before the Biden administration did this IDR account adjustment, it was estimated that literally about 150 people in the entire country had ever gotten their loans forgiven through this program, even though there were 9 million borrowers in IDR plans, and this program had been around for more than 25 years. So what the Biden administration decided to do, recognizing the glaring sort of glaring systemic failure of the program, is they created this one-time account revision that awarded retroactive credit towards IDR forgiveness for people with direct loans, or if you consolidated your loans before a certain date last year, based on a set of relaxed rules. So you got credit for periods in like forbearance or deferment, or periods where you might have been in a payment plan that would have otherwise been non-qualifying. That was all done during the Biden administration, and that program is over. So whatever credit that you would have accumulated, you have it now, but you can't go back and get the same type of retroactive credit based on this account adjustment any longer. There was a tracker on people's federal student aid accounts at the beginning of the year. It was taken down in February. However, the information about your qualifying payment count for IDR forgiveness is still in the system. One of the ways that you might be able to access it is if you log into your federal student aid account at studentaid.gov, open up a separate tab in the same browser, and then you'll get this link, which will be provided to you with the deck. You can copy the link into that tab, and it's going to come up with this kind of ugly looking sheet. If you see a little pretty print box at the top, you want to check that off. It will make it less ugly, but this is the less ugly version. You want to copy that or download it and save it. That is your information. You may not be able to understand it, but you can reach out to us and we can interpret it for you. But it gives you a sense of where you are in the IDR forgiveness journey, if that's the forgiveness program that you're pursuing. And just remember, it's going to show you credit in multiple different repayment plans, even plans that you're not enrolled in. But whatever credit that you've accumulated in these plans should be transferable to IBR and the new RAP plan, ultimately when those become the only two plans out there. And again, you're probably going to want to reach out for a little bit of help with that. We would be remiss if we didn't say a little bit about public service loan forgiveness. So just as a reminder, PSLF is a program whereby you make 120 qualifying monthly payments, so 10 years of monthly payments, after which remaining loan balances are forgiven. And a qualifying payment is any on-time payment made in full on or after October 1st of October 2007. That's when the program started. So anything that you did before then is not going to count towards PSLF. You must have direct loans. You must be in an IDR plan, or you must be making the payments in a standard 10-year fixed repayment plan. Although with the standard 10-year fixed plan, you can't stay in that plan for the life of the loan, or you'd pay it all off before you would get forgiveness. And then there's employment requirements. You have to work an average of at least 30 hours per week for one or more qualifying employers, which are typically a nonprofit or a government organization. The payments don't have to be consecutive. You can accumulate, let's say, 3 years worth of payments. Then you might decide to move to the private sector for a couple of years and come back to public service. When you come back, you do not lose the 3 years that you previously accumulated. When you reach that 120 qualifying monthly payments, you must meet the employment requirements when you submit that final application. So if you're close to 120 qualifying payments and you're about getting ready to file that last application to get your employment updated and you get your last qualifying payment counts, make sure you're employed at the time you submit the application. And then one of the best features about PSLF is it's not taxable at the federal level or at the state level in New York. And despite what you may read about student loan forgiveness becoming taxable starting in 2026, that only applies to the IDR or income-driven repayment forgiveness program that we just talked about. PSLF has its own set of rules, and the forgiven balances will remain non-taxable at the federal level. If you live in a different state, you have to check what's going on with your state, but in New York, it's not taxable at the state level either. For people, some people have heard about this program, other people have not. There was something out there called the PSLF buyback program. This was a new regulation that was implemented in 2023, although the account adjustment that we just spoke about kind of made it unnecessary until very recently. And what this buyback program allows you to do is purchase PSLF credit for months that you might have spent in a disqualifying payment status. And for a lot of people right now, that status would be like time spent in the save forbearance where you're not earning credit, might be eligible for a buyback, but you have to meet certain criteria in order to buy the loans back, buy the months back. Number one, you must have 120 qualifying months of employment on record. That's not qualifying payments, but months of employment. So that means you have to update your employment certification forms. And then the months that you buy back must basically bring you to 120 qualifying payments so you can get your loans forgiven. You can't purchase months prior to a consolidation. You can't purchase months spent in a school deferment or grace period or a default. And payments are may be based on the payments that you were making in an IDR plan prior to entering the disqualifying status, and immediately after exiting that status, if that's applicable at all. There is some question about how they're going to assess this for people in the SAVE forbearance, since they are um, prevented by law from billing people and using the SAVE formula. So they may calculate those payments using one of the other income-driven repayment plan formulas to give you your buyback. If you are eligible for the buyback, it's relatively easy to request it. You do that through the PSLF reconsideration portal on your federal student aid account, and then you just click PSLF buyback. The one thing to know about the buyback applications is it's a really slow process. And even before the shutdown, they didn't have very many people allocated towards processing these applications. It's a manual thing. So at the last status update that we saw, and this was in August, they were processing about 5,600 applications per month, but the backlog was growing to like over 74,000. And that's going to probably continue to grow, which just means that it could take a very long time to get these, to get a response once you request the buyback. Right now, it looks like it could take well over a year to clear the backlog. And that would have to be a consideration in your strategy on how to earn future PSLF credit. One of the things that you can't continue to do, and you should continue to do, however, is verify your employment by submitting the PSLF certification forms. Again, these are the forms that just verify that you've met the employment requirements of the program. It's a form that your employer would sign off on. This has nothing to do with how much you pay on a monthly basis. That's a separate thing and a separate form. If you want to, apply for a different repayment plan, that's a different application unrelated to the PSLF certification forms. You must submit at least one form for every employer that you've had, qualifying employer that you've had since October 1st of 2007 or later if your loans were dispersed later. And then you generally want to submit the forms annually or whenever you change jobs. There's no deadline for submitting the forms, but you must have a form on file to get all your qualifying payment credits. And the idea of doing it annually just means that you're keeping up with the qualifying payment count. And we've seen in a number of instances where people come to us and they've never filed these forms, or they haven't filed a form in 8 or 9 years or more than that. And then they have to go back and track down old employers who may not have their information or may not even be around anymore. So you really want to follow this rule of trying to do it annually or whenever you change forms. If you need to get caught up, they are retroactive. So if you can find your older employers, you can get caught up. The other key recommendation here is that there's different ways of filing the form. But if you use the PSLF help tool, which is on your federal student aid account, and you request an electronic signature from your employer, this is something that years ago was not available, those applications will process really quickly. If you submit something with a manually signed form, it could take a lot longer to get an updated qualifying payment count. Okay, I'm going to go through just some guidance on to borrowers now and the strategies that you should be thinking about depending on your circumstances. So if your strategy is to repay your loans in full, really not a whole lot has changed as a result of these new rules that have come into play. So you should just continue paying as much as you can. You might consider a standard plan or even an extended version of the standard plan, and pay as aggressively as you can to get the loans paid off. If you're pursuing income-driven repayment forgiveness or IDR forgiveness, that's that long-term 20 to 30-year forgiveness, there are currently 3 IDR plans available to people who are eligible. So there's IBR, Payee, or ICR. You may be eligible for 1 or 2 or all 3 of those plans. Remember, Payee and ICR are going to be phased out over the next 3 years. You should always consider IBR first. If you're what we call a legacy borrower, you're not going to be borrowing after July 1st of 2026. The IBR plan is the only of the existing plans that is going to continue to exist after 2028. But if that's not the cheapest plan for you, if payee or ICR are cheaper, you can enroll in those, excuse me, and pay in those for the next couple of years until you are forced to go into the IBR plan. And just remember, qualifying payment credit for this program that's earned in SAVE, payee, and ICR will be transferable to IBR or RAP. If you're pursuing public service loan forgiveness, if you're currently enrolled in IBR, payee, or ICR, continue making your payments to earn credit towards PSLF. If you're currently in the SAVE forbearance and you haven't yet selected a new repayment plan, you might consider doing that. You don't have to if there's nothing that you can afford right now, or if you think that your income is going to decline next year, so you want to wait until next year to submit these new applications and have it based on a lower income, or if the RAP plan is going to be the cheapest thing for you, but it's not going to be available for you until next year, you can remain in the SAVE plan. But if you want to get out of it because you're anxious to earn credit towards PSLF or some other program, again, we recommend IBR, but if the payee or ICR plans are cheaper, by all means, enroll in those. You will get qualifying payment credit in those plans. Once they disappear, you're going to have to transition to something else. Now, while your application is being processed, once you submit an income-driven repayment plan application, you may be placed in a processing forbearance. Processing forbearances are eligible for PSLF credit for up to 2 months. And then, of course, if you're eligible for the buyback, you can submit the buyback application. You just may not want to rely solely on that buyback as your means of getting PSLF. If it's going to take more than a year to get that application back, you may want to also switch into another income-driven repayment plan, start making those payments, and then see whichever strategy gets you to forgiveness faster. And then finally, if you're thinking about the new RAP plan, again, this is not available, may not be available until July 1st of next year. That plan may be cheaper than existing repayment plans, and existing student borrowers are going to be able to switch into that RAP plan when it becomes available. Now, if you do choose the RAP plan and you're not taking out new loans, it's not clear yet whether you'll be able to switch back into the IBR plan, although some of the most recent information I got says that you might be able to do that. That rule has not been finalized just yet. Payment in the RAP plan will count towards both PSLF and IDR forgiveness. If you're pursuing PSLF and the RAP plan is the cheapest option, then it's a no-brainer. Do the RAP plan. If you're pursuing IDR forgiveness, however, even though the RAP plan may be cheaper than some of these other plans, forgiveness in the existing plans is anywhere from 20 to 25 years. RAP would be a 30-year path to forgiveness. So even though the payment may be cheaper, you may wind up having to pay an extra 5 or 10 years, and that could definitely influence your decision of which repayment plan to move into. Okay, I'm going to stop there because I know we're getting close to the end, and see if there are any questions. Marie or Carolina, whoever's out there.
Nancy, there's no questions right now. Again, if anyone had something they wanted to clarify or anything you want to talk more about, feel free to type in the chat and we can elevate it right now.
Yeah, type in the Q&A.
Yeah, and
In the
also
Q&A.
since we're towards, oh, you still have some more, Nancy? I was gonna say there was someone who had raised their hand, so if we speed up through the process.
Yeah,
then,
I mean, if you with our technical problems, we probably wasted about 5 minutes or so. So let me just get through these last two. We're almost at the end, and then we'll address the people with the raised hands. So very quickly, total and permanent disability, or TPD, is a program that sounds like what it is. It forgives your debt if you have some kind of a disability, a mental or physical disability that basically prevents you from earning a livable wage. It doesn't mean that you can't work at all. Um, they have they've been transitioning the management of this program from Nelnet to the Department of Education. It's definitely hit some hurdles in the process. But you can submit these applications now from your federal student aid website, federal student aid account at studentaid.gov. And if you need help with this, I would say reach out to us and we'll walk you through the process. And then I did want to say a few words about delinquency, default, and collections because all during COVID, people really didn't have to worry about delinquency or about going into default, and certainly didn't have to worry about involuntary collections. But we're kind of beyond that period right now. So just a few tips. If your loan is considered delinquent if you miss one payment. If you miss 3 months worth of payments, the delinquencies will be reported to the credit agencies. And at 270 days, which is 9 months, you're at risk of going into default. If you're in delinquent, so meaning that you're not quite in default yet, you can contact your servicer, possibly ask for a retroactive forbearance. That means they backdate the forbearances and it brings your account current. So you're not at risk of either going into default or, it might not clear up any credit damage that's already, been assessed on your account, but it will prevent it from maybe getting worse. Then, but then you need to take the time. If you can request another forbearance, or you take that time to review your payment plans and maybe see if there's an income-driven repayment plan or something else that you can afford. That will prevent you from going delinquent. If you still can't afford anything, you can try longer-term deferments and forbearances, but that's not the long-term strategy. Eventually, you have to find something that will allow you to pay the debt back. If your loan is in default, so that's 9 months of missed payments, that means that when your loan goes into default, it means that the debt becomes payable in full immediately, which of course is a non-starter for anybody that's in default. It also means you're not eligible for income-driven repayment plans, deferment, forbearance. You can't earn credit towards forgiveness, and you have no access to federal student aid. Most importantly, it also means that you may be subject to involuntary collections. And the federal government can collect money in mainly 3 different ways without taking you to court. So they can take your tax refunds, and this actually did start back in May. If anybody received their 2024 tax refund and you're in default, that shouldn't be touched. But if you remain in default, you're at risk going forward. Your Social Security can be offset. They can take up to 15% of your Social Security, leaving you with only $750 a month. They announced the restart of this earlier this year, but then they put it on pause, and to the best of our knowledge, that has not resumed. They can also garnish your wages up to 15% of your disposable pay, which is something that nobody wants to see happen. They did threaten to send these notices out at the end of the summer. As far as we can tell, the notices haven't gone out. But the important thing to know is that despite the fact that they haven't actually, turned the switch fully back on, they will at some point. And if you're in default, you want to reach out now for help before you hit the point where you're getting some of these involuntary collections. And there is this Treasury offset program if you think you might be at risk of a tax refund offset or a Social Security offset. You can call this number and find out whether or not you're in the queue. And then finally, if you are in default, there are several ways to get out of default. We're not going to go over this in great details, but you can either consolidate your loan or do a rehabilitation process, which is pay 9 months over a 10-month period. You want to reach out to us if you're in default, and we'll go through and figure out what the best option is for you.